Hi, I am Momo Sobodo. If this is your first time of visiting my channel, you are welcome. In today's video, I'm going to share with you 4 tips which has really helped me improve on my trading style, psychology and analysis over the years, and which I believe it will also help you exponentially if you incorporate it into your own trading style. Stay with me till the end of this video. I bet you will not regret it. Tip number 1: market structure. Market is structured for a specific reason because the dynamics of the market is facilitated by huge and big entities such as the central banks, the commercial banks, hedge funds and other institutional traders. Especially the commercial banks, they create 80% of the market volume in which you and I also participate in. Hence, they know and they can see way too beyond the curtain as they are dealing with huge orders. That's why the market is always structured so as to they cannot trade against themselves. And it is important for you and I to know the structure of the market exactly we are trading in so as to it can help us make a profound trading decision. With that being said, let's take a look at the chart. This is gold on a daily time frame. We have the market creating this move from this low all the way to this high. Hence, we call it what? A structural range. Until price move out of this range, then we say a break of structure. As you can see, when price created this range, it retraces all the way to this lower point before it finally breaks out of this range. And if you can notice right here, we have that candle which first break the tail, you see, the highest point in this first structural range, okay, and then created this highest point. So we now have first structural range and second structural range. So this move from this lower point to this higher point, lower point, higher point, this is what we call a bullish market structure. After the market created this range from this point, it then retraces all the way to this lowest point and then move all the way to this high. We call it what? Another structural range. But what do you notice from structure 1, structure 2 and structure 3? We notice that the market has what? Decrease in volume and momentum. Take a look. The volume and momentum of this first structural range and the second structural range is not as the same as the volume and momentum of the third structural range. The third structural range decreases in what? Volume and momentum as it fails to what? Trade all the way out of what? Our second structural range. Yet it created this low point and what? Retraces all the way to this lowest point. When this lowest point was created, price then retraces. Upon retraces, we now have our structural range, range 4, as you can see, from this high to this low. After this structural range 4 has been created, price then retraces all the way to this highest point and what? Drop back, thereby breaking the low of structural range 4. You see, this bearish candle, you see how it closes below the tail of structural range 4. You see, it then breaks the range of structure number 4. And what happened? It created a new low. That after it created this new low, it then bounces back. It even came all the way to the high of that structure, you see, but it rejected, giving us a weak rejection. Price, a candle never closes above. If a candle were to be close above structural range 5, then we would have said a break of structure. Hence, we would have seen the market continue moving in this direction. But nothing like that happens. So here, we are expecting this market to continue dropping and create another new low lower than what? Structural range 5. Like this. And continue moving. in that direction. Okay, or we are expecting the market to create a new low lower than structural range 5 and still breaks structural range 3. And once price breaks structural range 3, then there is a possibility that price will continue moving in that direction. Hence, we will be looking for more selling opportunity than buying opportunity. That is if price breaks structural range 3. Remember, range 3 from this low to this high, this is range 3. So if price continues to trade all the way to structural range 3 and breaks, then we should start looking for what? More selling opportunities to that of what? Buying opportunities. At that point in time, we can now say the market has taken a complete turn from being bullish to what? Bearish. Remember, 4 and 5 are what? Bearish structure. As you can see, this low was created, lower low, lower high, lower low. Why this lower low was formed? Because bearish candle closes below structural range 4. You see, right? Hence creating another new low. Price then retraces another lower high, and we are expecting another new lower low, lower than structural range 5 for this market to continue moving in that direction. So basically, this is how you analyze your structural flow. This is how you can tell the flow of the market. By so doing, you know exactly in which flow you are trading in. Hence, it can help you make a profound trading decision so as to you cannot get trapped along the way. And take a look at closely structural range 5. Inside this structure, if we can zoom into 1 hour time frame. So in the 1 hour time frame, as you can see, this is what we call trend in trend. In a daily time frame, we notice the bearish structure of the market. But in 1 hour time frame, we have a bullish structure as price was creating series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, until price finally breaks to the downside. You see, right here, at this point in time, right here, you see, right there, we say break of structure. Once price break this lower point, it then retraces and start moving in accordance with the what? Daily time frame. So basically, this is how you analyze the structural flow of the market so as to you cannot get trapped.
On the hourly time frame, whenever you see a weak rejections, it signifies that that zone is a zone of what? Interest. Otherwise, the market wouldn't have what? React by rejecting. So whenever price reject at a particular level, bear in mind that that level, strong zone of liquidity. Hence, always look for your wicks in the market. On the chart in front of you, how many wicks can you see right now? Pause the video and count the number of wicks you can see. I mean visible wicks. Alright, let's do it all together. Let's say, for example, here we have our wicks at this level. We highlight that zone. Upon highlighting that zone, what can you see? When price came back to that zone, it then grabbed liquidities and dropped to the downside. Take a look at this wick which was created. When this wick was created, what happened? When price came back into that same zone, the market then gravitated to the downside. As you can see, this like how many pips to the downside? 173 pips to the downside. Also, if you take a look at this level here, these wicks which were created at this zone, if we extend our rectangular box line, you notice when price came to this zone, what happened? It then moved up to the upside. For the second time when it came, it then moved up before it finally break. And as it breaks, where next? This wick. You see, this wick, when price came for the first time, it moved to the upside. For the second time, you see, it started rejecting, telling us that this zone is going to hold. It's not going to break. Price is not going to break below this wick. Hence, it's going to what? Maintain. And it moved to the upside. When it came for the third time, finally, it then moved with huge momentum and volatility to the upside. Always look at your wicks. It's very essential. This information is a game-changing information if you use it accurately. Basically, liquidity flushing out is a phenomenon which occurs always in the market, where price gravitates towards highs or lows to clear out more orders before going back to its normal direction. In an uptrending market where price continues to create higher highs and lows, you will notice at one point, traders who took position from this level, thinking that the market will continue showing high. What happens? The market take a U-turn and gravitating back towards their position, thereby creating more anxiety into a lot of traders. Hence, they are going to what? Exit their position. That position they are exiting is going to serve as a liquidity to push the market to its initial direction. Also, you can notice that either a low will be taken out completely. You see, for example, this low which was created initially, the market came back. You see, the price gravitated back to this low, clear out more orders residing below this low. And what happened? The market then sprint to the upside. Take a look at this phenomenon as well. This low which was created at this level. Remember, we are in an uptrend. Initially, when this low was created, the market continues to go higher. But the market can no longer continue moving higher since there isn't enough liquidity. Hence, it gravitated back towards this low, thereby creating an anxiety in traders who took position at this level. Definitely, they are now going to what? Exit their position. That position they are now going to exit, and a lot of stop loss orders residing below this low, all of them are going to serve as what? A liquidity in order to drive this price to the upside. Conversely, in a downtrending market where price continues to create series of lower lows and highs, at one moment you will notice price will gravitate towards one of the highs, thereby grabbing all the liquidity residing above. When we talk of liquidity, we are talking of our zone of interest. If you notice at this level, traders have already what? Sold the market. But since there isn't enough liquidity to drive the market to the downside, what happens? Price then gravitates back to the same level, thereby clearing out all the stop loss orders, and a lot of traders exiting their position as price continues to what? Rise to their initial level. What happens? All those orders are now going to serve as what? Liquidity to drive the market to the downside. Also, as you can see, this high initially indicates what? Traders who sold at first, thinking that the price will continue dropping. Later, price gravitated back to that level, grab some more orders before it finally moved to its initial direction. As you can see here as well, this level, as traders sold from this level, pushing the price all the way to the downside, what happened? Price came back to visit that same level to get some more orders in order to what? Drive price to its normal direction. So this phenomenon is simply what we call liquidity flushing out.
So the last but not the least, we talk of support and resistance on wicks. How I go about my support and resistance and really benefit from them is simply identifying my wicks on the current market price. As you can see, we have GBP JPY. This is the current market price. Okay. Now, how many wicks can you see as we speak right now? Pause the video and highlight all the wicks you can see right now. Alright, let's do it all together. As you can see, we have our wicks here. You see, we have our wicks. Now, how do you benefit from trading support and resistance in this format. Let's say for example, you wake up and you find price at this level and you have your wick at this point. Just highlight that zone and wait patiently to see price reaction as it approaches your level of what? Resistance. In order for you to look for any buy opportunities, you zoom into the 5-minute time frame. On the 5-minute time frame, you want to see a break and retest of that level in order for you to take any buy position. Take a look at this level. As price approaches our level of resistance, it broke to the upside upon coming back to retest. That would be a very good buying opportunity. You see, it came again, retested for the second time and shot all the way to the moon. Let's go to the next point in 30-minute time frame. Always remember to highlight your wicks on the 30-minute time frame and wait for the retest. Recent support and resistance on the wicks. Remember, take a look at this wicks which were created at this point. We highlight that zone and zoom into the 5-minute time frame to look for any trade opportunity. On the 5-minute time frame, what's the criteria you should be looking for? You want to see a break and retest. As you can see, you see this candle which breaks upon price coming back to retest. A very perfect entry buy opportunity. What's the pip range? Let's measure the pip range. As price came back for the retest, assuming that you take a buy position from that level, this is like 70 pips to the upside. A very good sweet ride. Let's go back and look for another level. Let's delete this guy. Also delete this guy. Let's take a look at this level which was created. Remember, we have our wick at this point, and as price approaches that level for the first time, let's see the price action if we can find any trading opportunity. This is simple, guys. Trading shouldn't be difficult, guys. The most difficult part of trading is how you manage your psychology and emotion. So as price approaches that level, it breaks. Upon retesting, a very good sweet ride to the upside. You see, price break, there was no retest. It breaks up again, it came for the retest, and what? A sweet ride to the upside. So basically, this is how I go about trading support and resistance and benefit from it. I hope this video will be of help to you guys, and if you have any question, comment or thought you would love to ask, make sure you leave them in the comment section below. Until next time, have a blessed trading week.